but this is exactly how I expect it to go. The beast is rearing its head. They're going to have to print. They've already started. People look at interest rates. They watch interest rates way too closely. It doesn't matter they cut rates. It doesn't matter. It's how much money is there out there, not the cost of it. They are printing. And so I think Bitcoin makes a historic run.
Jack Mallers begins by highlighting a fundamental concern about our modern financial system: its fragility. At its core, Mallers argues that our current financial system relies heavily on trust rather than tangible assets. The money we use today is not backed by physical commodities like gold, but is instead printed out of thin air by central banks. This system, Mallers contends, is inherently unstable because it depends on the confidence of individuals and institutions. When this trust erodes, the consequences can be swift and severe, leading to cascading problems that affect the entire financial ecosystem. Mallers points to recent events as evidence of this fragility. For instance, he notes how small missteps or policy changes by central banks can have massive ripple effects, destabilizing markets and causing significant financial disruptions. This inherent instability is not surprising to those familiar with Bitcoin and its underlying philosophy, which was designed as a hedge against such vulnerabilities.
I think the financial system is just very fragile. We live in our modern day financial system is money that isn't backed by anything. It's printed out of thin air and relies heavily on trust. And so I think you just saw the fragility of the global financial system, which terrifies people. And again, when that trust breaks, things cascade on itself and problems can happen very quickly. So not shocking to a Bitcoiner, probably not shocking to your listeners, but it is the reality we live in, where the global financial system is managed by few key central banks. And when someone makes an oopsie or a decision or tightens policy, they collapse the whole set of dominoes. The debt crisis is the demand for United States government debt, which also is known as the bond market. And so what has happened is you had record money printing through COVID. So COVID, I think, was close to 40% of the US dollars that exist today were printed in the last 4 years. So excessive money printing, which leads to inflation. That's going to inflate the prices of goods and services. There's more currency issued than there are scrambled eggs, than there are Caesar salads, especially than there are Bitcoins, especially than there are Miami real estate, right? Then the way to stop that is to tighten monetary policy, which is effectively deleting dollars from the market, so that if you reduce the quantity of dollars, you're bringing the prices back down. The way to achieve that is to increase the cost of capital, is the interest rate. So they raised rates as fast as possible. All of that volatility in manipulating the value of money, which is really effectively our time and energy in an abstracted form, causes a lot of stress on the market, one of which has been the sovereign debt market, has been the bond market. So for the first time since the mid-1800s, we're in a very severe bond bear market. And so in my opinion, all of this unravels from that core idea, is that we've never been in a worse bear market for bonds, government bonds, unless you go back to 1860. So what actually happened is all of our wealth is stored in assets. You cannot store your wealth, your time, your energy in a fiat currency, because over time, fiat currencies are actively being debased. They're being inflated. They're worth less each day on average if you pan out over a long enough time span. So when they hike rates up as fast as they have and immediately start crashing banks like Silicon Valley Bank, traditionally you run to the bond market. Traditionally you get, risk-free interest rate, 5.5%. Why would you ever own gold? Why would you ever own Bitcoin? Unless there's a crisis in that market, unless those things are down 60, 70%. Then you got to go somewhere else. So what investors figured out is, hold on a second, Japan, they have zero interest rates. They still have no cost of capital. I can actually go borrow money in Japan instead of the United States of America, take the yen, swap it for dollars, and then use the dollars to buy the assets and hide in the assets. And so when you see gold making new highs despite high interest rates, when you see Bitcoin making new highs despite high interest rates, when you see real estate market not crashing, you're seeing Nvidia and the S&P 500 still ripping. Their times are still inflationary despite high rates. So there was still a lot of buy pressure, buy side on assets. And some of that was coming from what we're calling this carry trade, as the world went and found where money was free. So even though the Federal Reserve had the hardest monetary policy as a central bank relative to a lot of the other central banks, the world was still able to go borrow free money, swap it into dollars, and then buy a lot of the hard assets, quote unquote, that the world desires, which are traditionally American-based assets, which are tech companies in the United States of America, real estate in the United States of America. So as soon as Japan started to tighten monetary policy, which you can effectively suck in the air out of the room, you say, hey, all that free money borrowing, come back to daddy. Then you start to see these assets sell off. And usually what happens is the financial system, again, it's all on trust. It's all on promises. It's all on thin air. So what you usually see is people get blown out. So what it looks like happened is Monday morning, it smelled like dead bodies in the water. So I think that there are probably some dead bodies out there that had to be forced sellers. It's a difference if you're unwinding a position versus if you're forcefully being liquidated. And you can see that in how violent the markets can get. So it looks to me like someone was caught offside. Someone borrowed a little too much free money and had to puke a bunch of assets that they bought with that free money, which then causes something like Bitcoin to go down 20% and the S&P 500 and the Dow Jones.
For Bitcoin enthusiasts, Mahler's analysis provides a perspective on why Bitcoin might play a crucial role in the future financial landscape. Bitcoin is often viewed as a store of value that is immune to the whims of central banks and traditional financial systems. As fiat currencies are debased and inflation erodes purchasing power, Bitcoin offers an alternative that is not subject to the same inflationary pressures. Mahler speculates that Bitcoin could see significant appreciation in value, potentially reaching between $250,000 and $1 million per Bitcoin in the coming cycle. This projection is based on the expectation that central banks will need to engage in massive money printing to stabilize the financial system, thereby driving up the value of assets that are limited in supply, such as Bitcoin.
The total money supply is going up. It's broken out. I think the markets in times of crisis sell what they can, not what they want. If you in real time on a Sunday night owe a bank in Japan $100 million, $1 billion, you can't wait for market open on Monday to sell the piece of shit stock portfolio that you want to give them. You got to dump your Bitcoin. And so what does that do? That naturally misprices assets. You've got a lot of sell pressure on assets that you can sell, not that you want to sell. So that's when you get a market dislocation. So I think Bitcoin is dislocated from where it's probably naturally supposed to be priced, and it will go find that over the coming months. And then I think we're going to get the most money printing in human history. Central banks progressively try and price fix things. In 2008, it was the housing market. And now it's the sovereign debt market. It's the bond market. It's the holy mecca of markets. When people say we left the gold standard and we went on the dollar standard, not really. We didn't go on the dollar standard. Not all the wealth, the richest guy in the world doesn't have a bunch of dollars. All the banks own bonds, right? We went on the government debt. We went on the bond standard. And so if they're going to have to bail that thing out, that's the holy mecca. That's the final boss. The amount of stimulus it's going to take to bail that thing out and remain solvent, I think Bitcoin lands somewhere between 250 to $1 million this cycle for that very reason. So I don't know all the market events. Like I said, I don't want to be too casual in an economic crisis, but this is exactly how I expect it to go. The beast is rearing its head. They're going to have to print. They've already started. People look at interest rates. They watch interest rates way too closely. It doesn't matter they cut rates. It doesn't matter. It's how much money is there out there, not the cost of it. They are printing. And so I think Bitcoin makes a historic run. The problem Jerome Powell has is he's trying to beat inflation. He's trying to get it back down to his target, 2%, which, by the way, inflation should be 0 or negative. But whatever, we'll do 2%. The only way he can do that is continue deleting dollars, continue to raise rates, right? But that's not clearly what he's optimizing for. He's optimizing for an orderly market in treasuries, which is what Janet Yellen would want. So we live in a period of fiscal dominance. So what do I think he's going to do? If he actually cared and he was actually doing his job, You're right. He would have raised rates more. We'd be at 10% rates, 15% rates. All the banks are going to go under. But fuck the banks. Why would we care? You want to fix this problem? Remove the government guarantee that banks get bailed out. Remove FDIC insurance. Tell customers you can go anywhere. Stop criminalizing Bitcoin. Let people own what they want. Deposits will flee out of banks. Banks will be realized as insolvent. They'll all fall apart. We'll reset. Let's say you're a big tech public company, maybe $50, $100 billion tech company in the United States of America. You compensate your employees in stock options. This is a very common thing, right? Is that employees sign up, they get a salary, but they're really in it because they're going to get Meta stock or Amazon stock or whatever the hell. If you make a change, not even a Bitcoin change, but just a change where we say, we don't care about this upcoming quarterly earnings. We're changing our strategy. We're doing something big and different, and it's going to pay off years down the road. Well, the public markets are going to kill you for that. There's no low time preference in the fiat land in Wall Street. And so they're going to short the stock. Your stock's going to get crushed. Your stock gets crushed. All the compensation of your employees are crushed, right? Now your employees go from well-compensated, happy Silicon Valley engineers to poor. Your employees then leave. Your employees go to a competitor, and you've kind of just like totally unwound your company. So I think you've got complicated board structures, and you've got companies that are tied up in fiat nonsense. All right. Like, this is the web of spaghetti of fiat, is all of these equities. These things are people's savings accounts. These things are people's 401ks. These things are like everyone's future vacation, future engagement ring, future college tuition. And so they cannot make decisions like this without paying consequences, very likely from a fiat world. And there's cascading effects to that. So how does someone maneuver their way around without those dominoes falling? That's kind of, in my opinion, I'm just guessing. I mean, I don't know. I don't run a fucking public company, right? But that's what I think. It's harder than you think, in my opinion. And so it's probably going to take either some market events or, the US government adopting it, maybe new administration that doesn't criminalize Bitcoin. Maybe public sentiment changes a little bit, which allows for, if the public markets heard that someone was adopting Bitcoin on as a treasury instrument, that they wouldn't all freak out and short sell the stock. So that's kind of my speculative opinion.
Looking ahead, Mahler's envisions a significant transformation in the financial landscape. He anticipates that the ongoing instability will push more investors and institutions towards alternative assets like Bitcoin. The rise of cryptocurrencies and other decentralized financial instruments could redefine how we think about value, investment, and economic stability. Mahler's commentary underscores the need for a paradigm shift in how we approach financial stability and risk management. As traditional systems face increasing pressure, the role of Bitcoin and other decentralized technologies may become even more pivotal in shaping the future of finance.